In this chapter, we're going to talk about the decisions that an investor makes at the end of their holding period. What do I do with the property now that my horizon has ended? So, one possibility is to dispose of the property. So, that's why we call it disposition. So, we could sell the property. And over time, over that holding period, we could have enjoyed some equity buildup. So that's when we have positive amortization because the outstanding mortgage balance decreases as our equity position increases. So we have built up some equity in the project or in the property. And so that equity is the opportunity cost of not selling. Now, when we're trying to decide whether or not we should dispose of the property, then we need to calculate what our potential return would be for holding it versus selling. So we'd have to evaluate what we think or how we think the property would perform in the future, and also the tax consequences of selling it. So, will we have a gain and will we have to pay tax on that gain from selling the property? And if we decide to acquire another property, how will all of that work? So, we're going to have to evaluate that and factor it into our decision. Also, we need to think about those cash flows that we would receive after we pay the taxes from disposition and think about what are we going to do with those cash flows? Can they be reinvested at a greater rate of return than what we would enjoy if we just held on to it? So that knowing the answer to that question would help us decide what to do. And then what would the minimum after-tax IRR have to be on an alternative investment in order to make us indifferent between holding versus selling and buying something else? So, when we're calculating the returns to a new investor, there are some tax implications. So, tax law changes affect the relative benefits of existing versus new investments in the very same property. So, if there's a change in the tax law that becomes less favorable, that tends to work in favor of the existing investors. But on the other hand, if the new tax law becomes more favorable, then new investors tend to be favored because the new tax law is going to impact new owners. The existing owners are going to be bound to the tax law that was in place when they purchased. So now we need to be able to calculate the marginal rate of return. Remember, anytime you hear that word marginal, it means that we're referring to how we treat the next dollar of whatever. In this case, we're talking about the next dollar of income or cash flow. So the marginal rate of return is the return that will result from holding the property only one additional year. And so each year, the marginal rate of return is based on the benefit of receiving after-tax cash flow 0 for one additional year and after-tax cash flow the operating after-tax cash flow, and that is a typo, it should be ATCF. So one additional year of operating cash flows and then getting that after-tax cash flow from the sale at the end of that additional year. So we're pushing off disposition. So we end up with this formula. And so we're just going to assume that the reinvestment rate doesn't change. So what we're trying to figure out is our optimal holding period. And that's the point at which our marginal rate of return curve intersects our reinvestment rate curve. So now there are alternatives to selling the property at the end of our holding period. One alternative is refinancing. And so in order to determine if refinancing makes sense, we would need to calculate our incremental cost of refinancing. And so that is going to be done based on if the interest rate on our new loan is higher than the rate on our existing loan. In that case, the incremental cost of those additional funds borrowed is going to be even higher than the rate on the new loan. So let me say that again. So with refinancing, we are taking out a new loan on the existing property. And if the interest rate on that new loan is higher than what we had already in place, then the incremental cost is even higher than the interest rate on that new loan. And so the point is, when we're trying to decide if refinancing is a good idea, it's going to be based on that incremental cost. And so that makes sense. If you think about on residential property, if you're trying to decide whether or not to refinance your own home, typically you do it if interest rates fall. And so you can cut your interest payments. And so if you think about it the other way around, if you refinanced but interest rates were higher than when you initially financed the property, then that's going to work out to be a negative. So we would also be looking at our leveraged return from refinancing and then continuing to hold the property. And so we're calculating the impact of refinancing on our return. And so remember, if that new loan is at a higher rate, our incremental cost of refinancing is going to be higher than our original loan and the new loan. And so our leverage return from refinancing and holding will likely be lower because our borrowing costs have gone up. So now the other side of it, if we were able to refinance at a lower interest rate, we're going to use the same methodology, but potentially it's going to work out in our favor. And there also are some diversification benefits. If we can obtain additional funds by refinancing using our equity, then we can use those funds to invest in a second property. So then that may be one reason why we would refinance, so we can get some of the money out to diversify our portfolio with another property. Now, one other thing to keep in mind is perhaps we want to rebalance our portfolio. And so as an investor in income producing property, we need to take into consideration how the sale or disposition of our property would impact our mix of property. So remember, we talked about property types as residential, non-residential, and mixed use. And then within the non-residential, we had all those different types: office, retail, industrial, warehouse, apartments, etc. And so we want to think about our mix of properties in our portfolio, much like we would think about asset allocation in an equity or equity and fixed income portfolio. So, but remember, one of the big factors that we've talked about a couple of times with income producing properties is our own expertise and the management that we have in place. And so we want to leverage our management and our expertise against that mix of properties, meaning we want to make sure that we've got the properties that we have the expertise to manage.